This thing says live on YouTube. Is that what you want?
Yes, long.
This thing says live on YouTube. Is that what you want? Did you want it to be live on YouTube?
Yes.
Okay.
I received a request last night.
Did you want it to be live on YouTube?
Yes.
Okay.
Yes.
I received a request last night. Did you want it to be live on YouTube?
Oh.
Yes. Okay. Yes.
Okay. Okay. So go ahead, guys. Get started. See if you can share the screen. Are you able to share the screen? Okay. I can't hear though.
Yeah. Can you hear me?
There you go.
Where's my... All right, so I went on this morning and I looked at the top gainers and losers.
Okay.
And look at the top gainers and losers, and then I copied and pasted to. Hold on 1 second, please. Copied and pasted here on my sheet here.
Okay.
Then I copied everything here, or I highlighted everything here as we were talking before, and then I went to data.
Mm-hmm.
I went to short range. I went to I clicked this box here, and I went to column here. No, I didn't do that. I went to sort here. It had volume right here, so I went put a volume and then Z to A and sort, and I sorted it. I came back out and I went and I looked for, I think I remember you saying, I couldn't remember if it was 6 figures or 7 figures, but I just went to anything that wasn't 6 figures, highlighted it, then I X'd it out, crossed it out, and then I went back to the top ones here, the ones that weren't crossed out, copied. And then I went back to, I went into Robinhood, I believe.
Okay. Robinhood or Finwiz?
Finwiz, I'm sorry. Okay. Went to Finwiz, copied the ticker, put the ticker up here in this bar here, and I went and looked for market cap, looked for and the amount of employees. I looked for shares outstanding, short float. SHS float and short float. The short float was less than 1% or less. I copied it onto my my information page that I showed you earlier. This page here, Um, and then I went to look for like some news. I went to go look for the latest news on it and how it was doing in the news. Um, this top one here, I copied and pasted. I went back to here and put it in my news along with all the other things, the employees, the market cap, average volume, all the things that that I talked about earlier.
So what was the news? I couldn't read the text.
The news here, it was, let me go back. Yeah. Broadwin awarded 19 million. Let me get off of that. They were awarded $19 million for wind tower order.
I see. Okay.
Yeah, so I put that in the news just to in my notes. I didn't think that I didn't feel like there was anything that I went back and I looked on to I went to see how I was doing in Robinhood.
Mm-hmm.
And I didn't think that it was I looked at the trends and how it was doing. They had a spike. They had a really huge spike. Let me go back. Hold on 1 second, please.
Okay, so what do you think is the prospect of investing in wind energy at this time? You know, in terms of short-term to medium-term investment, is it appropriate? Do you see wind energy or more generally alternative energies uh, growing their businesses in the short term or medium term?
I feel like for the short term, because we don't know how things are going to return when we are done with everything with the crisis that we're in now. I believe that it definitely could have it does have its potential to do well because of what's going on, and we don't know how things are going to turn out, like when we're all done with everything, or how if we're ever back to normal. So I think that with energy and with like talked about the global markets and it's a possibility. I believe it could be a strong possibility. I believe that's why they were awarded money, because there may be a possibility that things could work.
So my read on this would be that, first of all, this is a $19 million order. It's not as huge of an order. Uh, we can expect that the demand for clean energy may continue to rise, but in the short term and in the medium term, the price of oil where it is, I do not expect that there would be a whole lot of activity on clean energy, at least in the short term. So putting money in as a swing trader may not be the best investment at this time. However, clearly a lot of other people disagree with me, and that's what you see in terms of this stock, coming to the top of that top gainers list with the respectable volume in the early hours. Okay, so let's go back to the after hours and pre-market overview.
I kind of thought what you were saying before, but I went away from it just because only because I've seen that they were awarded money. I kind of thought that I may have been wrong, but I was thinking on the lines of what you were just saying just now, and I kind of went away from it because, like I said, because I seen that they were more awarded $19 million. I didn't think that it was a lot of money either for like a big company or for a company. Like I said, I went away from my first thought.
Mm-hmm. What is the size of this company though?
They have hold on one second.
Go back to Finvis.
They have 521 employees. Does that go to Finwiz?
Yeah. What's the market cap on this?
Okay. 22.
Yeah. So for a company which has a market cap of 22 million, sure, 19 million is a huge order for them. So that's where that is the only place where it makes sense. But I've already said my piece about the sustainability of this clean energy in the near term. Okay.
I had a question.
Sure. Go ahead.
So I was looking up like market cap and exactly what it meant. And then it stumbled upon.
Yeah. So market cap means market capitalization. So what it refers to is the total value of all of a company's shares of stock. So what you do is you calculate it by multiplying the price of a stock by its total number of outstanding shares. Okay, total number of stocks multiplied by the current value of the stock price. So a market cap for a company may change over time. So let's say if a company has 20 million shares outstanding and their selling price is $50. So the market cap would be $50 times 20 million, which is $1 billion.
Okay.
Okay. Because
how the enterprise value is that any of any importance in regards to looking up stocks and like the amount of debt that the company may have and that kind of thing?
Sorry, say that again.
Enterprise value.
What is enterprise value?
With like the amount of debt that the company may have that they procure.
You're talking about market cap or the cash that they have?
Well, it has, the cash that they have and they have available, or the cash that they may owe out.
Yeah. So availability of cash is a very important factor, and we are going to talk about it today. We calculated with the number of ratios. One of those is called quick ratio, and I'm going to talk about that as we get into the new concepts today.
Okay.
So I want you to go to the after hour market page and
what does the gross margin
where
mean?
we are. Sorry?
What does the gross margin mean? It was on the previous one, sorry.
Where are you looking at?
On the previous page, there was something, it said like 8-point-something%, and then it's like gross margin.
Can you check that? Go back to Finvis, please.
Sorry.
Thanks. I'm pulling it up now.
So gross margin, so basically, gross, can you go back to that Finvis page, please?
Finvis?
Yeah. Just for a moment.
Sorry.
I know, in the table.
All right.
The table area.
All right.
Yeah. Where did you see gross margin? Which column?
Seventh margin. Okay, I'm right here.
Yeah, gross margin. So 8.7%. So basically, you calculate gross margin by taking the sales revenue, total net sales, minus the cost of goods sold. So, you know, the simple formula for a profit. Profit is equal to sales minus expenses. Does it make sense, Maya?
Mm-hmm.
Sales minus expenses is your profit. So you bought something, you had a sale of $10 million, but you had $8 million of expenses. That would be your gross income. But when you put it as a percentage, that would be your gross margin.
Okay.
Okay. So that's the difference between gross income and gross margin. The gross margin is written as a percentage. So it gives you a scalability. So let's say, you know, a company that has a market cap of 22 million versus a market cap of 22 billion, gross margin would allow you to measure apples to apples. So, and it is one of the measures. And there are a lot of other measures as we have seen on Finviz. You know, you see all this, the whole table, every single number means something, you know, in terms of evaluating uh, that company's ability to stay in business. And we'll talk about three of these in particular today as we get in. So uh, let's get back to the overview of the market from aftermarket page.
So this here.
Okay, go ahead. Tell us what are we looking at.
Right here, I'm not quite sure what this is.
Okay, so let's look at
gainers and losers. The gainers and losers.
No. Let's look at the markets. Go a little bit up. Okay, so U.S. stock futures. What are they doing? Are they up or down?
Up.
Up. Is that a significant number though? The 1.52%, 1.07%, 1.74%. Are these significant numbers?
I would say I don't think so.
Well, look at it. You know, Dow 1.74% means 417 points.
Okay.
You know, that's quite substantial. That's a respectable number. That's not. We cannot say that this is uh, not a good number. So it is a good number.
So how did you tell that? How could I tell that?
You look at,
you said looking at the Dow.
yes, Dow is doing 417% up from yesterday, and which is 1.74%. Nasdaq is up 94 points, which is 1%, and then S&P is up 43.75%. So that's quite respectable after our activity. If you go further down, go ahead, go down. The world markets, you see there, generally they are up, but Japan's stock market, it closed in a negative territory, but it was only negative by 0.06%. So 0.06% is not a huge thing. So I wouldn't call it mixed closing on international markets. You know, general trend is still upward. You can see Hong Kong market closed 1.22%, which is quite respectable. England closed 2.21%. Germany DAX market closed 2.15%. So you can see Japan is further east. So Then Hong Kong is a little bit to the west of Japan. But as you come further west, you see the later in the day, market started to do better. Then you look at, yeah, go ahead.
So when looking at this, so anything that is trending upward, like, or that is always green, is that just always, you assume that it's always good, or that it is always good?
Yeah, green means the markets are ending up higher. So usually these would have an impact on the US market as well, but not always. Generally speaking, that the world is in a good mood. The investors are feeling good about the economy. So everywhere it is going up. So, if this was mixed or if everything was red, then you would expect that that would have an impact on the US markets as well, in terms of negative impact. So, yeah.
For the other thing at the top where it said, when we were talking about the increases, it had the word levels. What does levels mean?
So level of a stock market is calculated based on a number of factors. So let's look at one of this. Let's look at Dow. What is Dow? Is Dow a market? Is that a stock market?
No. Dow is, you said it's a group of some top stocks that they piled together based off of their performance.
So Dow is not a stock, right? A stock market, right? So Dow is a list of companies, basically. How they select how a company ends up on Dow. The Dow committee makes that decision based on a set of criteria. So once a company is on that list, they aggregate value of those stocks in a day and report overall upward or downward trend in the stock pricing for that list of 30 companies. You can have different companies. You can have S&P, you can have S&P 3000, you can have S&P 1000 or 500 or 100, or you can have NASDAQ. NASDAQ is an actual a trading platform, right? So that is an actual stock market. So you can, so that level would include all the companies that are listed at NASDAQ. So NASDAQ is an online stock market, and mostly the tech companies are listed on NASDAQ. So let's ask, can you please share your Thinkorswim? Can you please bring Thinkorswim?
This is it.
No, Thinkorswim.
Oh.
It is. I don't know what's wrong with the
Oh, because you may have shared just one screen. So stop sharing and share desktop, share full screen, not just the browser.
It only gives you the option to only share one thing at a time, but we'll do it this way.
Okay. So okay, on your left-hand side, you have a watch list just below Trader TV. So click on that gear sign at the bottom. Yep, there you go. And cross out Trader TV. And cross out live news. And cross out quick chart. Okay, so that leaves you with one watch list. So go to watch list up there. And first of all, click that chevron, the first chevron on the leftmost side, that arrow sign, click that sign. Okay, and now select watch list. Go to public watch lists and find where's NASDAQ Composite. Check the next one. Do you see NASDAQ?
Yeah. NASDAQ Composite.
NASDAQ Composite, yeah. Okay. Increase the size of this window. No, go to the towards the bottom of this table. No, just this table. And the cursor will change. Yeah, cursor will change. No. That bar, the bottom bar that you see. Yep, there you go. Click and drag down. Okay. So these are companies that are listed on NASDAQ Composite. So this is a very long list. If you see that that slider on the right-hand side within the left column, within this table, the slider.
Slider.
Yeah. No, a little bit to the, yeah, in that area. Click somewhere. Yeah, you see that slider? So that's a very long list of companies that are listed on NASDAQ Composite. So to reduce this number, let's go to NASDAQ 100. So NASDAQ 100 would be, again, that list of smaller list of companies. Click on NASDAQ Composite. Go to public F-R and select NASDAQ 100. Okay, so now this is a list of only 100 companies. And look at this list. What kind of companies do you see here? Do you recognize any names here? Any tickers? Anything that stands out? Keep going down. Do you see Apple? Right there.
Apple, Amazon.
That's Apple. Amazon. Keep going down. eBay. Intel Corporation. Okay.
Is that CERN?
I don't know what CERN is, but we can look at it. But right off the bat, you see Apple, Amazon, eBay. What kind of companies are these?
Really big companies.
Technology companies, online businesses, mostly. So that is what NASDAQ specializes in. NASDAQ specializes in listing. It is a stock market for companies that are primarily technology companies. Okay.
Okay. Yes.
The companies that are listed on Dow, the list of 30 companies, those are primarily large cap companies. Okay. And then S&P, again, depending on which list are you looking at, it may have some common theme of how those companies end up at that list. Okay.
Yeah.
And I see Subira doing really nice notes in the chat. So thank you, Subira. Okay. So that concludes our overview of the market. Let me share my screen. Okay. So just very quickly, especially Miriam, Razan, because you'll be doing this on Thursday. Very quickly, when we start the class, we start with after our market update. So this data is as recent as 9:18 a.m. Eastern time. This is yesterday's close. So yesterday market closed up. Dow went up 309 points. NASDAQ 71.5%, S&P 33.77. Overnight, after hours, the S&P was up 42 points. So this jump in the after hours was more than the whole day on S&P yesterday. Oh, actually, this is right now. This is 9:37. It is already 9:37. So this is today's data now.
Are you sharing the right screen? Are you sharing the right screen?
Are you not seeing it? Okay.
I see gross margin.
Okay, let's see. Okay. You still see it, right? You see after hours screen?
Yeah, that's the right one. We only see a portion of the screen, but it's the right one. We see a portion of the screen, but it's the right one.
I made a few changes to the settings over the weekend, which has caused this situation. Okay, hold on. Let me advance now. Where's the full screen? What about now? Do you see full screen?
Yes, sir.
Okay, thank you. So, so after hours, markets were all up. So we can have a fair expectation that the world market would be generally doing up, which is what happened yesterday. Generally, they were up. Japan was a little bit down, but this down was not a huge negative. It's a very small 0.06% negative. Crude oil. So if you remember yesterday, crude was doing almost $17, $18. Overnight, it went down below $11. At some point, I saw 10 point some change. It went back up a little bit, but it still is down. So based on other factors, based on after hours US stocks, based on world markets, we can see that the markets should do well today. But crude oil, because the prices went down significantly from yesterday, it also shows that that the supply, not only the supplies, the increase, the storage is an issue. It continues to plague the economy significantly. So you can see, you might be able to see that the oil companies are not doing as well today compared to yesterday. I would expect that. Then there's this huge news item. Could US oil prices go negative again? It's possible. So this is still a factor. So this is where we are right now. Let's look at the current situation with the markets. So I click on this link up top here, markets. So this brings up to the current data from today. Dow is up 1.2%, 290 points. NASDAQ up 67%, S&P 34.83%. Again, we see that same number. Oil, this area would give you the world markets. It's just that this, it's basically a different way of showing that same data. Then sector performance, and then same commodities. So that's what's going on. This chart that I talked to you about a few days ago. This is fear and greed index. Let's go to CNN Business. Let's see if there's a news that Okay, bracing for oil to go negative again. So these types of news have an impact. This is like um, self-fulfilling prophecies. The news makes it even worse, but the news has to report what they are expecting. So you can see that oil is is going to be in trouble for at least in the short term. Um, US oil drops as much as 20%. Market rally continues as oil keeps plummeting. So apparently, uh, just oil itself does not have a huge impact on the market. Um, okay, I'm trying to see. There was a news item that I thought was very interesting. I saw that last night. Um, okay. Let me bring up that news item. Okay, you see this coronavirus market dashboard, right? Okay, so this is a very nice page. I think it's worth bookmarking. Business/market/coronavirus on CNN. Major US indices. Then they are categorizing these stocks very interestingly. Stay-at-home stocks. So they're putting Netflix, Peloton, Grubhub, and Activision Blizzard in that category. So what's happening with Netflix doing $413 a share, which is down 8.12%, $8.12. Peloton is down since yesterday. This is yesterday's data. Um, Grubhub was up. Activision Blizzard is down. Then they have work from home stocks. So Zoom, Okta, and Slack Technologies, they are in that category. Then stocking up stocks. So all the grocery stores, Walmart, Costco, Target, CVS, Procter & Gamble, and then Campbell Soup. Then airline stocks. So yesterday they were all up except for Southwest Airlines. There was a sharp decline just before the market closed. So, but even with that, apparently this was still 55 cents up. Southwest Airlines was 20 cents down. Then hotel stocks, then cruises, concerts, and theme park stocks. Of course, gaming stocks, biotech stocks, prevention stocks, so 3M, Clorox would be under that category, oil and oil stocks, macroeconomic risk indicators. So except for this, where you cannot directly invest, these are just the macroeconomic risk factors, risk indicators. Everything else is a very nice category of where your portfolio should be diversified, that you should have something from each of these companies, not a whole lot, but you should be invested. You should have at least some shares in most of these companies, if not all. For me, again, wherever there's alcohol involved, I would not invest, personally speaking, and I would not invest in things like gaming stocks. But everything else seems to be a pretty good area where my portfolio should be diversified. Okay, so with that being said, I want to take a little closer look at the airline stocks today. And I also want to see, I want to evaluate those three ratios that I talked about, I wrote in my email yesterday. So we talked about quick ratio, return on assets, and debt to capitalization ratio. And I put those definitions in that email. No, how do I, this is irritating today, Okay, so I'm gonna just bring it here and I'm gonna share that screen. You don't see my email right now here, right?
I put it in the chat.
Sorry?
I put it in the chat too.
Okay, so I'm gonna go back to share and select this screen. Okay, you see my email, right? Yes?
Yes.
Okay. So quick ratio is company's liquid assets divided by current liabilities. Return on assets is divided by yearly net income divided by total assets. And debt to capitalization is total debt divided by total available capital. Let's look at some of these companies' balance sheets and income statements. So let's pick one of the easy ones, American Airlines, right? So that's, everybody knows that. And American Airlines balance sheet. Are you still seeing my email, or you seeing Google search?
Google
search.
Okay, awesome. So we go to Wall Street Journal. Oh, they're saying data is not available. So let's go back to the source. Let's find American Airlines financial. So this is coming directly from, no, but this is GCS-web.
Is it on Yahoo? Is it on Yahoo Finance?
I was trying to see if American Airlines has it posted on their own website. But we can check at finance.yahoo as well. Okay. So this is a balance sheet. A balance sheet always has two sections. One section is called assets, and the other section is called liabilities. So remember, anytime you see a balance sheet, you're looking for two sections. One is called assets. Of course, it'll have a lot of different types of assets. It will end with something that would say total assets. And then there's a second section called liabilities. So here's the liabilities section, liabilities and stockholder equity. But the moment you see liabilities and stockholder, you know that this is the second section. And here's the thing about balance sheets. Assets are equal to liabilities plus stockholder equity. So you will never see a balance sheet where the bottom line of total assets does not equal total liabilities. They must equal dollar to dollar. See, total assets 59,995,000, 59,995, 60,580, 60,580, 51,396, 51,396. So you know that if you see a mismatch between these numbers, you know immediately that there's something wrong with that balance sheet. Now let's take a closer look. What is under assets section? And these 4 lines are for the 4 quarters. Current assets, cash. What do you see in cash? Cash and cash equivalent, $280 million at the end of last quarter in 2019. Last quarter of 2018, they had 275,000, 295, 332. So it gives you last 4 years, last quarter of last 4 years, and a comparative analysis of what's happening with these companies. And you can see they're fairly consistent. The lowest amount was $275,000 cash equivalent. Maximum was 322. So in that interesting that that a company like American Airlines has cash or cash equivalents of around $300,000. Anyway, short-term investments. Short-term investments would be that these are investments that can easily be converted into cash. So these could be cash equivalents. And then here's the total cash: 3.8 million, 4.7, 5 million, 6.3 million. So what's happening? What is the trend that you're seeing here? Year to year for the last quarter. 2016, 6.3 million, then 5 million, then 4.7 million, then last quarter of 2019 was 3.8 million. So the total cash is reducing. So 4 years ago, they had more than $6 million. Now they have less than $4 million in cash, total cash. So year to year, they are they have less cash available. And of course, a company that has a lot of cash available at the end of the year is a better company compared to a company that does not have enough cash, because that means ability for this company to meet its obligations, ability of this company to pay its bills. So companies that are cash strapped, that cannot meet their immediate obligations are a bad news. Then they have net receivables. So these are billed amounts that they are expecting within the next 30 days or some reasonable amount of time. So that is also an asset for a company, that they have money coming in, that they have billed other companies for this much amount, and they're expecting that money to come in a fairly quick turnaround. And then they have inventories. So total current assets are $8.2 million. Then if you look at non-current assets, so non-current assets would be that are assets, but you cannot easily convert them. You cannot quickly convert them into cash, but those are assets nonetheless. For example, a company may have buildings. Company may have a company would, like American Airlines would own airplanes. So those are all assets. If in a worst case scenario, they would still be able to sell those assets and convert them into cash, but it's not easy to sell a piece of land or a large building or an airplane. Those are not easy sales. They take time. So under this category, they would list non-current assets: property, plant and equipment, gross property, accumulated depreciation. Each of these have their own meanings. I'm not going to go through them at this time, but nonetheless, these are all assets. Now, they also have their goodwill listed as an asset. So does the name American Airlines carry some weight? You know, so that's where goodwill factor would come in. Intangible assets, assets that you cannot touch, you know, such as software and those types of things. Other long-term assets and total non-current assets. So then you take current assets and non-current assets, that will give you total current assets. Then you have liabilities. In terms of liabilities, current debt. Current debt would be the debt that needs to be paid now. You know, this is something that has to be paid, you know, in a short time period. Accounts payable. People are billing this company for their services that they're providing to American Airlines. So that's the information that goes under accounts payable. Accrued liabilities. So this is also payments that still need to be made. Deferred revenues, revenue that can't be realized right now, that's deferred. And other current liabilities. So that gives you total current liabilities. So again, current liabilities would be something that's due right now, just like current assets would be like cash, cash or cash equivalent type assets. Those are current assets. So current liabilities are cash liabilities that the money has to be paid now. And then there are non-current liabilities that would be long-term liabilities. For example, long-term debt, like mortgage, deferred revenues, other long-term liabilities. Then total liabilities would give us a number. And then on top of that, we have stockholders' equity. Stockholders' equity would be the amount of money that's available as a liability that has to be paid should the stockholders ask for their money back, or if they sell it back to the company, or the company wants to buy back stock. So so that's actually, I wonder if this is in the thousands. Okay, so these all numbers are in the thousands. So what you see is 1,000 is missing. So when you see this 4 million, it's not 4,000, it's 4 million. And where you saw, you know, number like this, 3.5 million, that's not 3.5 million, that's 3.5 billion, because all numbers are in the thousands. Then they have retained earnings of 2.2 billion, because you have to add another 1,000 here. Accumulated and other comprehensive income, negative 6 billion. Total stockholder equity, and then total liabilities and stockholder. Now, you can use some of this data to calculate some of those ratios. So for example, the first one, quick ratio, is liquid assets divided by current liabilities. Liquid assets divided by current liabilities. Both of these numbers are available in this balance sheet. Okay, so what's the first number? Company's liquid assets. What is liquid asset here? In all these rows, which one is liquid asset? It would be total current assets. That is the liquid asset. So cash and cash equivalents, that would be considered liquid assets. So $8.2 billion divided by current liabilities. Where's the current liabilities section? Total current liabilities, $18 billion. So $8.2 billion divided by $18 billion. Okay, I'm sure you can't see my calculator. Can you?
No.
Okay, anyway, so I'm going to do 8.2 divided by 18. That gives me 0.45 555. So 0.45. And since I have to convert it to a ratio, so that would be, well, that is 0.45 would be the ratio. So that's quick ratio. A ratio, quick ratio would be between 0 and 1. So between 0 and 1 would represent a quick, would represent any ratio, basically. Any question up to this point? Any question?
No.
Okay. So the higher the number, the higher the ratio, the better that company is equipped in terms of cash. So, so total current assets divided by total current liabilities. If this number is closer to 1, that means that this company is financially sound in terms of meeting its ability. So a ratio of 1 would be that they have cash available to cover all of their current liabilities. A ratio, a current ratio, quick ratio of 1 means that they have all the cash available to meet all of their current liabilities. That is a very good thing for a company to have, close to 1. If the quick ratio is closer to 0, that means that this company is in trouble. That company is in serious trouble, that they are not able to meet their immediate liabilities, their current liabilities with their cash assets. Okay, let's go back to the formula or the definition. Quick ratio measures short-term liquidity and cash flow.
Question for you.
How do you calculate this?
Can you tell me what the calculation is again, please?
So I calculated as of December 31st, I calculated it as 0.45.
No, what? Okay, never mind. I see the quick ratio calculation right there. And you calculated American Airlines as what?
So as of December 31st, 2019, their quick ratio on that particular day was 0.45. So 0.45 means that they are able to meet 45% of their current liabilities with their cash equivalents, with their total current assets.
45% is not a good number, right?
Well, it's a respectable number. Of course, we would want it to be close to 100%. That would be ratio of 1, right? So if it was 0.95%, that company would be in a very good shape. But if they're able to meet half of their liabilities with current assets, current liabilities with current assets, that's not a very bad thing. But like I said, the higher the number, the better that company is better able to handle their short-term liabilities. So what would a company do if their quick ratio is not close to 1?
Sell assets.
They either have to sell assets or raise capital by selling more shares, so that would increase the shareholders' equity, or get a loan, right? So they'll have to do something to increase that ability. So if you are comparing two airlines and you're looking at their balance sheet and you're calculating their quick ratio, that would tell you which company is more solvent than the other. Now, there is a difficult way of doing this, that you actually pull these balance sheet for each of these companies, which I intended for you to do, but there is an easy way. So I'm going to show you the easy way. The easy thing is you go to Finviz, put in any company's ticker, and as a result of this ticker, this table that shows up, this is one of the items here. So this number would change on a quarterly basis. So most recent balance sheet, according to that, their quick ratio is 0.3%, 0.3. So what does 0.3 mean?
It means it's not so good. It's even worse than the 45%.
Right. So it means that they're able to meet 30% of their current liabilities with their current assets, right? Which would be expected. Wouldn't you expect that these days for an airline, right? So that's where their quick ratio stands. Let's go back to the next ratio. Next ratio is return on assets. Yearly net income divided by total assets. Now you've got total assets from this balance sheet, right? But do you have net income on this balance sheet? No, we do not have net income. For net income, you look for a statement called income statement. An income statement on Yahoo Finance for each of these publicly traded companies is given right here. So we click on income statement. An income statement is not like balance sheet. It does not have two sections in that sense, but it still has two sections. So what are the two sections of an income statement? The first one would be the revenue, and the second section would be the expenses. And how do we calculate profit for a company? Revenue minus expenses, right? That would give you the profit for that company, or income, net income for that company. So let's look at it. Total revenue. Again, all these numbers are in the thousands. So $45 billion in revenue. Let's look at this one. This is December 31st, 2019. $45 billion in total revenue. And then they have cost of revenue. Or if this was a company like Walmart, then it would say cost of goods sold. Okay, because how does Walmart make money? They buy goods, they sell goods. So they have revenue minus cost of goods sold. But in this case, they don't have goods, they have service. So instead of saying cost of goods sold, they have cost of revenue. So they have revenue, and then they have cost of that revenue. So they do the cost of revenue. That gives us gross profit. So they have a $10 billion gross profit as of 2019. Then they have operating expenses. That would include selling, general, and administrative costs. That would give you total operating costs. So you take that number, gross profit, minus this $2 billion of administrative cost. That gives you total operating expense. Then you have operating income and loss by deducting total operating cost from gross profit. So $10 billion minus this $7 billion, so that gives you $3 billion in operating income or loss. Now you have still other expenses. Interest expense on the mortgage that they might have, total other income / expense net, income before taxes, income tax expense, and then income from continuing operations, net income. So that's where you get net income. What was the number that we were looking for? Net income divided by total assets. So what is the net income here? $1.6 billion divided by total assets. So let's go to balance sheet again. What were the total assets? Total assets. So as of December 31st, 2019, total assets were $59 million, billion dollars. And net income during that time period was 1.6 billion. So 1.6 divided by total asset, divided by 60. That is what's going to give you return on assets. Easy way to calculate that, to find that out, it's already calculated here. ROA, 2.8%. Any question? Okay, hearing none, I am going to move on to the next one. Debt to capitalization ratio. Total debt divided by total available capital. Total debt divided by total available capital.
I have a question.
Yes.
Was that a good number?
Is any number a good number? You have to compare it. So we've got this for American Airlines. Let's do the same thing for another company and then compare it. Give me another company.
Delta.
Delta, DAL. Their return on assets is 5.4%. So now you tell me whether this 2.8 was good.
Well, 5.85% is definitely better than 2.
Right. So let's look at quick ratio. 50%.
Yeah.
So by looking at these two numbers, now you are able to compare apples to apples. Between Delta and American Airlines, clearly Delta Airline is much better positioned, right, in terms of cash flow and their ability to use their capital in the best possible manner, right?
Yes.
So, and again, every single cell in this table has meanings. So you knew about some of these cells before. Now you are getting to know about these two at this time. So let's go back and look at debt to capitalization ratio. That's total debt divided by total available capital. So where do you think these numbers are going to come from? Total debt. Is that a income statement number? Anybody?
I think it's in the first one.
That would be balance sheet.
Mm-hmm.
Right? Because balance sheet talks about debt and assets. Right?
Yeah.
Income statement does not talk about debt, or it talks about debt servicing, but it does not talk about the debt itself. So income statement would only have revenue and expenses. That's income statement. So very simple way of looking at it. Revenue minus expenses equals profit or net income. So, of course, there's a difference between net income and profit. because net income is still not profit because there's still other liabilities that have to be paid. Okay. But we can sure call it gross profit. Gross profit we calculated right here. Total revenue minus expense to cost of expense, cost of revenue. That gives you gross profit. Excuse me. Okay.
Question. What
yes.
is the so kind of where you just had your cursor, it says TTM right next to breakdown. What does that mean?
I do not know what TTM means, but we know who would.
Google.
Nope. Yep, on an income statement. Okay, trailing 12 months. That's what TTM means. Okay, trailing 12 months would be that today's income statement, trailing 12 months would only include the last 12 months. So it would not be January to December income statement, would be trailing 12 months. You understand trailing 12 months now, right?
No, you just said it wouldn't have January to December, which is what I thought it would be.
Okay, so it would not be just from January 1st to April 28th.
Okay.
Okay, that's not TTM. TTM would be last year's April 28th to this year's April 28th. That would constitute trailing 12 months.
Mm-hmm.
Okay, so tomorrow, then you take away that for April 28, 2019. You start with April 29, 2019 to April 29, 2020. So immediate 12 months time period, that would be TTM. Okay, so we can calculate that, or we can just go to Finviz and look at their debt to equity ratio. So for American Airlines, they do not have anything calculated. So sometimes data may not be available in a format that can be calculated easily, but you can see that this is already calculated for Delta Airlines. Because sometimes the way formula needs a number, that number may not be available on the balance sheet or on the income statement in a easily calculatable manner. So for example, total debt, even though you can tell that this is a number that would come from balance sheet, there was nothing in here that would use the word total debt. It says long-term debt. So which we would expect that is the number that we are looking for. So using that number, we should be able to calculate that. So this long-term debt, 21 billion. So I'm just going to use 21, let's keep it simplified, divided by total available capital. So on this balance sheet, excuse me, this is income statement. Yeah, this is income statement. So let's look at balance sheet. Where is total available capital? They don't have a number listed as total available capital. And that would be one of the reasons if Finviz does not have a number, because the number is not presented in the manner that the formula in Finviz would be expecting. But let's look at the definition. So total capital usually refers to sum of long-term debt and total stockholder equity. Both of these items can be found on balance sheet. This is one of the calculations that is traditionally used when determining companies' return on capital. So long-term debt plus shareholder equity. So let's look at this again. Long-term debt is $21 billion and shareholder equity is minus $169 billion. So let's calculate that. 21 billion, 179 plus, well, actually minus because there's 169. So that gives us 21 billion even. And then we had total debt. Where's total debt? Total debt, total debt. Total long-term debt. So 21,179,000 divided by 21 billion 010. So 21,179 divided by 21,179 divided by 21,079. That gives us about 1.0. Check where my wallet is. It's not here. Okay. So this comes out to be 1.0. For Delta Airline, it's already calculated 1.19. So that means debt to equity, they are better leveraged than American Airlines. So for most of these companies, you would not have to worry about calculating these individually because they're already calculated in this table. But should this number not be available in FinViz, you now know how to calculate that you just have to look for the income statement and the balance sheet for a company and find those numbers and calculate. So what does this number really mean? It means debt position and overall financial soundness of a company with significant capital expenditure. So would you think that that airline industry is has a significant capital expenditure? Airlines. Yes, Maya. Airline industry is one of those industries where there is a significant capital expenditure for them to stay afloat.
Oh, that means how much they have to spend to stay afloat?
Right. So they have huge expenses, so higher the number, the better it is, better that company is equipped to deal with their capital expenditure. So capital expenditure would be, so for example, buying a new airplane. You think that would be a significant concern for an airline industry? Buying a new plane, right? Do they have enough capital to be able to go and buy, to make capital expenses, to make new investments? So the better debt to a capitalization ratio they have, the better it is for that company to continue to make progress in their discipline. Not just be worried about their operations, but also be able to make new investments. So a company with a lot of assets, with a good debt to capitalization ratio, would be able to make those expenses, those capital expenses, in terms of expanding their business. So, okay, now here's the assignment. Remember that table that you make on a daily basis? you usually copy a list of companies from the pre-market market watch. Now you're going to do something manually. For that table, you're going to recreate it. You're going to, where's the capital, the market watch here, the market watch. Okay. So you're going to calculate this, you're going to create this table. Okay. Don't worry about this first column, percentage, don't worry about that. But put everything else in. Last stock price at the time that you were looking at this, at the time that you were creating this table, their price, their symbol, their company name, and that day's volume of stocks for that company. Where are you going to find that number?
Finviz.
Where?
Finviz.
Finviz. Where Finviz? Which part?
On table.
Okay.
I thought I was muted. I wanted somebody else to answer. Sorry.
Okay. So volume is right here. Okay. So that's there. Today's volume. So you put that. Where is it? Yep, right here. So you put that volume. So you got 1, 2, 3, 4 columns, and then you're going to add 3 more columns to it. One column would say quick ratio, another column return on assets, and debt to capitalization ratio. So these 3 numbers, and then you're going to put each of these companies in Finviz and pull out these numbers for each of these companies. Does it make sense? Right?
Mm-hmm.
Not
so
difficult.
Is
right?
it just for, so when we do that, is it just for like the when we pull out the top grossing stocks, or you want us to do that for the airline companies?
Just for the airline industry. Okay, just these companies.
Okay.
Okay, so what this would do is, this would give you a better insight into the airline industry. If you wanted to make an investment, these 3 numbers will guide you of which companies' stocks you should buy and which companies you should stay away from. You can do the same thing with, for example, with oil companies. Now, you know that left and right, a lot of oil companies are declaring bankruptcies. Yesterday there was so in this news item that I had shared yesterday, which I received actually last week. You saw that USO is already, people are expecting that it is at the brink of collapse. Do you own stocks in it? I certainly do, and I'm worried about it. But at the same time, I'm looking at the macroeconomic factors, and I'm hoping that USO would survive because it's an oil fund. It's not a company. Now, they may be invested in companies that are going bankrupt. So if companies after companies in USO start to go bankrupt, that could sink a fund.
They can't just reinvest in different companies?
Well, they have to sell the stock in those companies that are sinking. But how do you sell a stock for a company that is already sinking?
Got it.
Right? So there may not be buyers. So you could create the same table for oil funds, ETFs and the stockbroker managed funds. Charles Schwab has its own list of energy sector companies. Fidelity does, Vanguard does. So they take money into their mutual funds or electronically traded funds, and they put money in a number of companies. Now, if one company goes bankrupt, it's okay. the fund which should still survive. But if companies after companies start to go bankrupt, that is a big problem for that sector, or for that fund. So if we go back to CNN Business, let me see if I can find that news of yesterday's yesterday's bad news that was coming in terms of companies declaring bankruptcies. There was one called Diamond, something Diamond. Let's see if I can still find it. Apparently it's not here anymore. Let me see. I'm pretty sure I had it sent to someone. Excuse me. Okay. Give me just a moment. Let me pull that link from yesterday, as companies were declaring bankruptcy. So I think there are 5 major companies that have already filed for Chapter 11 protection, which is the bankruptcy protection. So what happens is when somebody declares a bankruptcy, this line of long-term debt, a lot of that gets wiped out. So there may be other things that may be wiped out on this liabilities side. So where is it? Okay. So I'm not able to find it. Let's go to Google and let's see. Done. Oh, right here. See, I knew it was somewhere. Okay. Oil company Diamond Offshore files for bankruptcy. Now, if you look at it, it was a company that was providing services to 15 rigs working for Hess, Occidental, Brasileiro, and British Petroleum. And if you look down here, according to bankruptcydata.com, this is the 5th publicly traded oil company to file for bankruptcy in just the last 30 days. Many more oil bankruptcies are expected to follow. The largest to file so far is Whiting Petroleum, WLL, which filed bankruptcy on April 1st. Whiting was once a rising star in the shale industry with 1.6 billion in sales last year, but like Diamond Offshore, Whiting had posted a net loss in 4 of the last 5 years. So what is WLL doing right now after it has filed for bankruptcy? Let's look at it. Okay, its stock is trading at $1.12, which is actually up today. Let's look at 5-day, 1 month, 6 months. Okay, go back to 1 month. So Whiting Petroleum, they filed for bankruptcy on April 1st. This is April 1st. So before that, they were trading at $1.12, and the day they filed their bankruptcy, they went down to 38 cents a share. But since then, they have recovered significantly because they may have been able to, I don't know the details of what happened with their bankruptcy, but it looks like investors are feeling good about this company. It went up to $1.87, and now it is back down to 1.14. So it looks like it may have found its normal operating point. But if you look at this is April 7th. Okay, so this is all after coronavirus. But if you look at this company was already on decline since January 7th. It was constantly on a decline trajectory. And then end of February, this is where Corona hit. And then it went down further and went down to 33 cents a share. Okay, so let's look at one other thing. I have not visited this website before, so I would like to do that. Okay, the database of record for corporate bankruptcies and restructuring information. Okay. Alaskan Airline files plan for liquidation. Looks like a good resource. I would like to bookmark this. As part of my things, Frontier Communications Corporation court approves $1.3 billion private sale of debtors. Revenair Group.
Sorry, how'd you get to that site again?
Bankruptcycompanynews.com.
Okay.
I think that's what it was. No, bankruptcydata.com. And how did I find it? By just reading the news. So as we were reading this news, CNN was quoting bankruptcy.com. So, even though I had not seen this website before, looks like a good resource to have available handy to see what's happening with different companies.
I'm not seeing a way to put in that to put in a ticker though. You got to subscribe to it.
Well, let's see.
No,
hold on.
No, it's Bang.
Does not look like a very user-friendly website, but you can still search. Here's the search option.
Bankrupt.
Mm-hmm. So what they did was WLL. The reason they are still in business, because look at this, even though they filed for bankruptcy, what they did was they are planning on debt for equity exchange. So debt for equity exchange would mean that all these companies that have given them debt, they are now going to become shareholders. You get that?
No.
Okay. So let's say you want to start a business.
Yes.
And I loan you $100,000.
Yes.
Sometime later, you say that business is not doing well. I don't have any way to pay you back, but I invested my $100,000 as well. You gave me $100,000 as a loan. We will now become a 50-50 partner, and we'll see how the business goes.
Okay.
Okay. So that is what's called a plan for debt for equity exchange.
Okay.
Okay. So I'm no longer somebody who has loaned you money. Now I'm a partner. So, okay. So that's why this company is still, in the business. Anyway.
I have one question.
Yes.
This is the same case with the ROE.
No. Nope.
What's the difference between the ROE and definitely this is the same equity? When
ROE is return on equity.
Yeah.
This is debt for equity exchange. So any loaned amount would be converted into shares. Now, whatever happens to the share price. So for example, I've got shares now instead of a loan. So the difference between loan, difference between debt and equity is that if a company is liquidated, debt obligations are paid first before equity is paid. So shareholders do not get the first dibs on getting their money back if the company had to liquidate its assets. Okay, the first dibs are for the debt holders. So the company has to pay back its debt. If something is left over, then it is divided up among the shareholders. But now, since the debt is now converted into equity, people are taking a higher risk.
I see.
Okay. Now, the difference between debt and equity in terms of profitability is that people who have debt, who have loaned amounts, you pay, even though you pay a fixed amount of interest on it, on the loan, the amount of interest is smaller and it's fixed.
Okay.
So it is fixed for the investors because they gave loan to a company. They don't care whether the company does very well or just mediocre, as long as they continue to get their interest being paid to them. Now, shareholders on the other side, they're taking a larger risk. So they also expect larger return. So the rate of return on equity should be higher than rate of return interest rate. Okay. Now, because they are wiping down their debt by issuing stocks. Now, those companies that had given them debt, now they are assuming more risk. Okay, now they become shareholders instead of debtors.
I see.
So, and we'll talk about that ROE at another in another class, but that's a different concept. Okay.
Thank you.
Okay. Any more questions? Okay, hearing none, it is 10:45, way above our normal class time. So let's call it a day. The reason I put it on YouTube, so I don't have to download the recording and then upload it to YouTube. So it is already recorded for people who were not able to attend or who had to leave early. I'll share that link in just a moment. If you have any questions, please feel free to reach out to me. Now, the plan for Thursday is that Razan and Miriam, they are going to lead the conversation for the market overview. I would also like to ask you to do something to focus on your Think or Swim platform and show me what you are doing and how you are doing on your investments of that $100,000 worth of paper money. Just so you know, even though I was not focused on that much, I have about $3,000 made on Friday on that $100,000 worth of paper money, which is not a whole lot. I didn't spend much time, but I would expect that you should, you should be able to spend a little bit more time, see what's happening with the companies. If you choose wisely, I think you have a very good chance of making good money today because overall trend in the market is still upward. So let's see what's happening.
I have a question.
Right. Yes.
Real quick. So if I'm losing $873 right now since the PL since opening, for UCO, should I sell them?
Okay, I will let you make that decision as long as you're dealing with paper money.
Yeah, paper money.
I'm losing with them too.
Okay.
My strategy.
I'll let you make the decision. You've got plenty of money in that account. And then you can tell me how you made that decision and whether that was a good decision or a bad decision. Continue to, even if you sell, continue to monitor to see whether your decision was a good decision or not.
Okay.
Okay. Any more questions? Okay. So hearing none, I thank you for attending the class today. I appreciate it very much. And I hope that you are learning at least, something getting out of this class.
Definitely.
Definitely. Thank you.
You're welcome.
Thank you. Bye.
So much.
Look forward to seeing you on Thursday. Take care, guys. Bye-bye.
Bye-bye.